Hello, my name's Joseph Graff. Before I get started with the video today, I want to tell you all that this video is just one part of a 500-part series where I analyze the 500 largest companies in America. If you enjoyed today's video, I'll include some links in the description below so you can check out my other stock analysis videos. Also, if you enjoyed today's video, please hit the like button, please subscribe to the channel, and please hit the notification bell so you can be notified when I post future updates. This helps the channel to grow. With that being said, I want to thank you all for watching, and here's the video. Disney was founded in 1923 in California by Walt Disney and his brother Roy. Disney specializes in mass media and entertainment. They own a wide variety of films, television networks, and theme parks. Disney's operating segments include a media network segment, a segment that is parks, experiences, and products, a studio entertainment segment, and a direct-to-consumer and international segment. Disney's largest segment in 2019 was their parks, experiences, and products segment, which was responsible for $26.2 billion in revenue. Disney's fastest-growing segment in 2019 was their direct-to-consumer and international segment. This segment had a greater than 100% increase in revenue from 2018 to 2019. Disney is currently the 18th largest company in America and is valued at $235 billion. In this next slide, I'm going to show you all the company's earnings per share and earnings growth over the last 5 years. In general, good companies are able to produce positive earnings year in and year out and grow those earnings steadily over time. Large, stable companies such as Coca-Cola tend to produce positive earnings, but they might grow those earnings a little bit slower than a company like Tesla, which may produce negative earnings per share some years, but is generally viewed as having higher growth potential than a stock like Coca-Cola. In general, stocks that post positive earnings year in and year out, like Coca-Cola, tend to be considered less risky investments as compared to stocks like Tesla that may post negative earnings per share some years. In 2014, Disney stock earned $4.26 per share for the year. In 2015, this jumped up 15% to $4.90. In 2016, they earned $5.73, which was a 17% increase from the previous year. In 2017, their earnings dropped slightly down to $5.69. This was a 1% decrease from the previous year. In 2018, their earnings jumped all the way up to $8.36 per share. This was a 47% increase from the previous year. And in 2019, their earnings dropped back down to $6.64, which was a 21% decrease from the previous year. On average, Disney has grown their earnings per share 9% per year on average since 2014. Now that we've taken a look at the company's earnings per share over the past 5 years, we're going to talk a little bit about its price to earnings ratio, also known as PE ratio. PE ratio is simply calculated by taking a company's price per share and dividing it by the company's earnings per share. If you were trying to decide between buying shares in two different companies and everything else was the same, you'd want to buy the company that had the lower price to earnings ratio. This would be because you would be paying less for a company that is earning more per share. In general, companies that have a PE ratio below 20 are considered to be value stocks, while companies with a PE ratio above 20 tend to be growth stocks. In general, stocks with lower PE ratios are companies that investors tend to be a bit more pessimistic about the company's future, whereas stocks with higher PE ratios are companies that investors are a bit more optimistic about the company's future. PE ratio is just one small metric in the tons and tons of metrics that you can use to evaluate companies, but it goes a long way in helping you to get a baseline feel for why the company is valued at what it's valued at. As of August 9th of 2020, Disney stock was trading at $129.93 per share. If you look at their PE ratio based on the last 12 months of earnings, their price to earnings ratio is actually negative due to all the losses they've incurred recently due to the closure of their parks because of the coronavirus. To put this into context, the 12-month trailing price to earnings ratio of the Standard & Poor's 500 is 28.8. As I mentioned earlier, a company's price to earnings ratio is just one metric that you can use to value the company. Another popular metric is a company's price to earnings growth ratio. This is calculated by taking a company's price to earnings ratio and dividing it by the company's growth rate as a percentage. In general, companies with a price to earnings growth ratio of 1 are considered to be fairly valued. Companies with a price to earnings growth ratio above 1 tend to be considered overvalued, and companies with a PEG ratio below 1 tend to be considered as undervalued. Price to earnings growth ratio is a popular metric among investors because it takes both a company's price to earnings ratio and its earnings growth into account. These two metrics are the two main metrics that drive a company's stock price and thus its valuation. As of August 9th of 2020, Walt Disney stock was trading at $129.93 per share. As I mentioned on the previous slide, Disney's price to earnings ratio for the past 12 months is negative. So their 12-month trailing price to earnings growth ratio is going to be negative as well. It's kind of hard to use this metric to really judge Disney stock because they've incurred a lot of short-term losses due to the closure of some of their parks, and I feel like this metric does not truly reflect Walt Disney as a company. In this next slide, we're going to be going over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are popular among many investors because it's a way for investors to see a return on their investment in the form of cash payments. However, keep in mind that when companies decide to pay dividends to investors, that money that is returned to the investors is money that the company cannot use to reinvest into its own company. Dividend growth rate is the rate at which companies grow their dividends year after year. In general, investors like to see a high dividend growth rate as it means that they are receiving more and more money in dividend payments year after year. Dividend payout ratio is the percentage of a company's earnings that they pay out in the form of dividends. In general, companies with a dividend payout ratio below 70% have a good chance of being able to keep paying their dividend into the future and have some potential to grow that dividend in the future as well. Companies with a dividend payout ratio above 90% are generally seen as more risky and have a higher likelihood of cutting their dividend. Disney suspended their dividend as of May 2020. Before they suspended their dividend, they were paying out 88 cents per share per quarter. It is possible that their dividend may be reinstated when and if the parks open back up to full capacity. I think that there's a good chance that Disney will reinstate their dividend in the future, but until they can fully open up all of their parks, I think they will continue to have a suspended dividend. In this next slide, we'll look at two more metrics that you can use to value a company. The first that we'll look at is price to book ratio. You can calculate a company's book value by simply summing up all of its assets and subtracting its liabilities or debts. You can calculate a company's book value per share by taking its book value and dividing it by the number of outstanding shares. And then you can calculate the company's price to book ratio by taking its price per share and dividing that by its book value per share. Price to book ratio is a good way to get an idea of whether a company is overvalued or undervalued. A company's debt to equity ratio is calculated by summing up all of its debts and dividing that by the total shareholder equity. Debt to equity ratio is a good metric for finding out how much a company uses debt to grow their company. In general, companies with a lower debt to equity ratio will tend to do better during a recession. However, debt is a tool that companies can use to grow their company faster than they would if they did not have any debt. So debt is not necessarily a bad thing. Disney's book value per share as of June 2020 was $48.21. This represents a price to book ratio of 2.69. Disney's debt to equity ratio as of July 2020 was 0.6. This isn't a terribly high debt to equity ratio, but you should note that this is actually Disney's highest debt to equity ratio that they've had in more than 15 years. In this next slide, we'll take a look at how the company's stock price has changed over the past 3 years, 5 years, and 10 years. Keep in mind that a company's past performance does not guarantee its future performance. However, seeing that a company has done well over the past couple years is usually a good sign and can indicate that the company may continue along that path in future years. If you would have bought Disney stock 3 years ago and reinvested all the dividends, you would have seen an average annual return of 6.4%. If you had bought it 5 years ago, reinvesting all your dividends, you would have seen an average annual return of 2.6%. And if you had bought it 10 years ago and reinvested all your dividends, you would have seen an average annual return of 14.5%. As you can see from this information, Walt Disney would have been a good investment about 10 years ago, but it really has not performed that great over the past few years. In this next slide, I'm going to give you all my grades for this stock. The first grade that I will give you is what I grade this stock as a defensive investment. This grade is simply a grade that I give based on how well I think a company would do during a recession, as well as how confident I am that the company will continue to generate the same or greater earnings over the next couple years. The next grade that I will give is a growth grade. This grade indicates how I feel about the company's growth potential over the next 5 to 10 years. The third grade that I will give is the company's value at its current price. I'll take a look at what the company's price is at the time I recorded this video and give you all my opinion on whether I think it is undervalued or overvalued. The last grade that I will give you is an overall grade. This is a grade that looks at this company as a long-term investment. This grade indicates how comfortable I would be with holding this company for 10 to 20 years. As a defensive investment, I gave Disney a B-. If you would have asked me about 6 months ago, I probably would have given them an A- or an A. But with everything that's going on right now, with their parks only being open at a certain capacity, I'm a bit concerned that they're going to be able to generate the revenue that they were in the past. As a growth investment, I gave them a B+. I really like what they're doing with Disney Plus, and I think they have some really good opportunities to grow here in the future. As for Disney's value at their current price, I gave them a C-. I personally feel like Disney stock is a bit overvalued right now. I think there's too much to worry about with them being able to open up their parks to full capacity. I'm not sure when that will be, if that will ever happen, and I think that is certainly something that investors maybe should be a bit nervous about. As an overall investment, I gave Disney a C. If you would have asked me 6 months ago, I probably would have given them an A or A-. I do really like Disney as a company, but there's just a lot of uncertainty going on with them right now.